Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name is Michael, and this week we'll be discussing why institutional adoption could change the Bitcoin narrative. Happy 100k Bitcoin to all those who celebrate. Bitcoin has been in the news again for a few reasons. Firstly, last week it just passed the milestone of $100,000 per coin, though it did pull back shortly after. Secondly, the incoming US administration has talked about a Bitcoin strategic reserve. Thirdly, more companies are discussing the idea of adopting it as a treasury reserve asset. And lastly, the ETFs are reporting growing inflows and assets under management. This week, we wanted to discuss some of those news items, what institutional and corporate adoption of Bitcoin would mean for the commodity, and those stocks that are exposed to it. But before we dive into what happened in markets this week, here's our quote of the week from Satoshi Nakamoto. Most of the value comes from the value that others place in it. Gold, for instance, is pretty, non-corrosive, and easily malleable, but most of its value is clearly not from that. Brass is shiny and similar in color. The vast majority of gold sits unused in vaults owned by governments that could care less about its prettiness. Now, let's dive into what happened in markets this week. Here's a quick summary of what's been going on. Firstly, from ABC News, Meta to invest $10 billion in new AI data center and in renewable energy to power it. What's our take on this news? Good news for nuclear and for solar and wind, which can be brought online faster. Meta's new data center in Louisiana will be a mile long and use several gigawatts of power. Meta has already committed to invest $200 million to ensure the water and road infrastructure can support the facility. Local utility Entergy has committed to increase generation from gas-fired plants to meet the power demands. However, Meta also aims to deliver enough renewable energy to the grid to offset its consumption. Meta is seeking proposals from nuclear developers for 1 to 4 gigawatts of power by 2030. That doesn't mean Meta has stopped investing in other forms of clean energy, but nuclear projects have a much longer lead time. If data center power demands increase faster than nuclear projects come online, which we discussed recently, there could be more opportunities for renewable developers. Next up from Barron's. Salesforce jumps as investors focus on AI agent despite its earnings miss. What's our take? Is this the first big AI app? Salesforce's earnings were below consensus estimates, but the stock price jumped 10%. Investors were excited by the promise of its new Agentforce product. We mentioned in our recent recap on AI that the first big AI app could be an AI agent, and Salesforce is one company going big on agents. The market seems to agree, but it is very early. Agentforce was only launched in late October, just before the end of Q3 for Salesforce, which was 5 weeks before the earnings call. Mark Benioff said 200 deals have been signed, and the pipeline was looking good. We will only really know what that means for revenue in the next 1 or 2 quarters. Next up from CNBC, Robinhood considering a move into sports betting. What's our take on this news? Speculation is very profitable. That is, for the platforms that it happens on. Robinhood followed the speculative activity from crypto to meme stocks and then same-day options. Sports betting seems to be a logical next step. The potential for big payouts makes it easier to build margin into prices of derivatives and probably on betting odds too. A move into sports betting could be profitable for shareholders, though possibly not for customers. For customers, at least sports betting can't be confused with investing, unlike meme stocks and options. As always, the odds are stacked in the house's favor. Next up from Reuters, China bans exports of strategic metals. What's our take on this news? Didn't China do that a year ago? In August 2023, China severely restricted the export of germanium, gallium, and antimony. At the time, this was interpreted as a ban, but this time it's for real. This move isn't actually a reaction to Trump's tariffs, but to the Biden administration's latest curb on chip sales to China. These metals are actually quite abundant and can be produced in quite a few countries. But China is the low-cost producer, so that's where it's typically sourced. Production can be ramped up elsewhere, but it might take a while, which could lead to delays for manufacturers. This wasn't a huge surprise, so most have probably already built up some inventory, but we will likely hear about more potential bottlenecks in the next few months. Next up from the Financial Times. GM takes more than $5 billion charge against China businesses. What's our take on this news? Like Buffett says, the auto industry is just too tough. Most automakers, including manufacturers of electric and combustion vehicles, are having a hard time at the moment. General Motors' US business has been a bright spot recently, with robust SUV sales and EVs now breaking even. Over in China, though, things aren't going quite as well. Sales at GM's joint venture with SAIC are down 59% in the last year, as competitors like BYD have managed to sell cheaper vehicles. GM is writing down the value of its joint venture by $2.6 billion and taking a similar restructuring charge. These are both non-cash charges, but they will affect net income. On the positive side, GM will have less exposure to China's market, which is becoming ridiculously competitive. And last up from Le Monde, France's PM resigns after no confidence vote. What's our take on this news? Political gridlock is unlikely to fix sluggish growth. France's Prime Minister Michael Paige resigned after losing the no confidence vote. His government lasted exactly 3 months and seemed to echo Liz Truss's disastrous spell as UK PM. Mohamed El Arian pointed out that it's quite different. Liz Truss worsened a bad budgetary situation at a time of global financial uncertainty, while Barnier was trying to fix a bad budgetary situation. Europe is also in a stronger position than it was at the time of the 2012 debt crisis. Still, France is struggling with slow growth and a wide budget deficit. It now looks like Parliament will be gridlocked for the foreseeable future, so don't expect to see a solution anytime soon. Now, let's dive into the main piece. The renewed interest in Bitcoin. It's fascinating how much can change in 12 months. This time last year, the news around Bitcoin was about the ETFs possibly being approved in early 2024 and the block reward halving in April. Now, besides the new all-time high being reached last week, the news revolves around a possible US strategic Bitcoin reserve, possible further adoption from companies as a balance sheet asset, and record-breaking inflows into the ETFs. The Bitcoin bulls seem pretty happy about it all, so let's go through each story briefly and then discuss what these trends could mean for Bitcoin and the stocks exposed. But before we do, it's worth briefly mentioning the high-level narrative that the Bitcoin bulls believe, and we'll cover the bearish narrative later on after the stories. So, what is the bullish narrative behind Bitcoin? The main premise of the argument from the Bitcoin bulls lies in the belief that it is a better store of value than alternatives and that currency debasement will continue. Estimates are that there is $900 trillion in global wealth spread across real estate, equities, bonds, money, art, cars, collectibles, and gold. Some of that value is the utility of those assets, like living in a home, dividends from a stock, or gold used in industrial cases, etc., and the remainder of that value is a monetary premium. The thinking is that the monetary premium baked into their value is above and beyond their utility value, and that premium has only accrued because investors bought these assets more and more over time in an attempt to outpace inflation and maintain their purchasing power. Some bullish estimates would say that half of that value, or $450 trillion worth, is simply a monetary premium. If that's the case, then their thinking is that Bitcoin could grow to that value or more, given the belief that it is a better long-term store of value than those other ones because it is more durable, portable, divisible, and more scarce. As a store of value, these assets each have their pros and cons. Bitcoiners believe that if you're simply looking to maintain or grow your purchasing power over time, then Bitcoin serves as a good vehicle to do that. As for the currency debasement argument, that is simply referring to the belief that many governments will need to continue to print money to afford their growing deficits and debt levels. By that notion, more money would be in circulation, inflation would continue, and scarce assets would appreciate in price because the thing they're being valued in is becoming worth less over time. If you believe all that, then you're probably bullish on Bitcoin too. We'll cover the bearish narratives and risks later on once we've covered the news stories. So, let's get into what the US government strategic reserve could mean for US treasuries. Would the US build a strategic Bitcoin reserve? At the 2024 Bitcoin conference, President-elect Donald Trump gave a speech where, among many things, he promised to establish a US strategic Bitcoin reserve. Just like the US's gold reserves at Fort Knox or its oil stockpiles at the 4 major strategic petroleum reserves locations around the country, a strategic Bitcoin reserve would be set up in a similar way, if approved, of course. The idea came from Senator Cynthia Lummis, a Republican from Wyoming and Bitcoiner, who proposed a piece of legislation called the Bitcoin Act. The bill aims to improve the national economy and address the growing national debt. What's the goal? Well, accumulate 1 million Bitcoin over the next 5 years, hold the Bitcoin for at least 20 years, and then use it only to pay off the national debt. We don't have too many more details to go off, but that's the general premise of the act. Considering that the US government already owns an estimated 200,000 seized Bitcoin, they have about 800,000 left to buy over 5 years. Just FYI, the chart above was from April this year, so the values are probably 60% higher, and Germany no longer owns any Bitcoin after it finished selling its seized Bitcoin on July 12th. The Bitcoin Strategic Reserve Plan will only work well if the bullish narrative on Bitcoin plays out. So, whether that is a smart move or not will depend on what happens to the price of Bitcoin over the next 20 years. As a thought experiment though, if the US government managed to buy the remaining 800,000 Bitcoin at $100,000 per coin, price subject to volatility of course, then it would spend about $80 billion on top of the $20 billion it already owns. If that $100 billion appreciates at say 30% per year for 20 years, which some bullish Bitcoiners believe can happen, then it would reach $19 trillion, which is great. However, while the deficit is currently at $36 trillion and growing, in this scenario, it would only pay off about half of the current debt. To be fair, that's still much better than nothing, but unless government expenses are reduced or income increases significantly, that $36 trillion debt balance is likely to keep growing. So in that scenario, it would be less than half the balance. The prospect of Bitcoin becoming a reserve asset could also cause some concern for US leaders. If it does, and the world piles into it, would it undermine the USD and US treasuries? Well, there are two ways to look at it. If Bitcoin becomes more attractive than treasuries, demand for treasuries could fall and yields would rise. That would make it more expensive to fund the deficit. Alternatively, if investors liked Bitcoin and wanted bond exposure to a country that held Bitcoin in reserve, they might view US treasuries as more attractive. In this case, demand may remain, yields on treasuries could stay flat or even reduce, and that could help make the deficit more affordable. This idea of a strategic Bitcoin reserve is not a sure thing yet, and it's not without its drawbacks, such as possible seizure risk and possible price manipulation. Over the next few months, the price of Bitcoin is likely to be very sensitive to what Trump and others in the administration say and do with regard to this bill. If it does go ahead, the thinking is that there would be a big buyer wanting to purchase around 800,000 Bitcoin, which would push the price up of the scarce asset. Now, let's discuss what's happening on the corporate side of things. Will companies buy Bitcoin? Management teams have the all-important role of capital allocation. Their goal is to allocate it where they will generate the highest risk-adjusted return for their shareholders. If a company has cash on their balance sheet, they could choose to do a few things: reinvest it in the business, distribute funds back to shareholders via buybacks and/or dividends, pay down their debt to reduce leverage, keep the cash for optionality, or they could do a mix of the above. It seems that since 2020, despite plenty of reinvestment and capital returns to shareholders, companies have actually managed to increase their cash stockpiles too. US companies currently hold around $4 trillion in cash, while companies across the globe hold similar amounts. Corporations are well aware of the fact that inflation is reducing the purchasing power of their cash balances over the long term, but they also want to keep the optionality. Plus, holding cash reduces their short-term liquidity risks. While some public companies have already started acquiring Bitcoin for their balance sheet, it seems the estimated number of private and public companies using the same approach is growing. Microstrategy is one company that others are looking to for what can occur when Bitcoin is on their balance sheet. That company has gone from a 30-year-old enterprise software analytics company worth $1.5 billion in 2019 to a 35-year-old Bitcoin holding company worth $90 billion. The company obviously believes in the bullish narrative around the commodity, and they noticed an opportunity to give institutional investors exposure to Bitcoin, all while those investors remain within their investment mandate. For example, for funds that can only buy credit instruments but want Bitcoin exposure, the company issued convertible bonds. For funds that can only buy equities but want Bitcoin exposure, the company issued new equity. Microstrategy managed to not dilute shareholders because the company is trading at such a high multiple above its net asset value, and the Bitcoin per share keeps increasing. A Microsoft shareholder, NCPPR, recently raised a proposal for Microsoft to put at least 1% of its treasury into Bitcoin. The board has voted no and suggested the shareholders do the same, but the vote will be finalized on December 10th. NCPPR got Michael Saylor to do their presentation to their board on their behalf, and he was given 3 minutes. Whether it gets voted for or against, it's still a big moment for a $3 trillion company to discuss the idea of holding it as a reserve asset. Anyway, while other companies might not follow the exact same MicroStrategy approach, they're considering if allocating a portion of their cash reserves to it is right for them. Smaller companies like Metaplanet, Semler Scientific, and others have started adding Bitcoin to their balance sheet as a diversification strategy. With regard to capital allocation, if a company is presented with an investment opportunity that could generate returns above the cost of capital, that's something they'll consider. So, if there is a portion of that $4 trillion worth of capital that starts to think that way and flow towards Bitcoin, then, same as before, that could create a situation where demand outweighs supply. Of course, not every company wants to own Bitcoin, and those that do, not everyone will want to hold it directly. The responsibility around self-custody can be quite daunting. Some companies might be happy to own an instrument that gives them exposure to the underlying asset. This might explain the other recent news story about the Bitcoin ETFs and their inflows. So let's talk about that now. Bitcoin ETFs receive record inflows. Since being launched in early January this year, the Bitcoin ETFs have attracted significant inflows. This is likely from a mix of both individuals and institutions wanting a bit of exposure but not wanting the job of self-custody. According to Bloomberg ETF analyst Eric Balchunas, IBIT, the Bitcoin ETF from BlackRock, took 211 days to reach $50 billion in asset under management, and that is the fastest in history. Apparently, the second fastest ETF to reach $50 billion in asset under management was IEFA, and it took 1,329 days. In case you're not aware, IEFA is an ETF investing in international small, mid, and large cap stocks in developed markets outside of the US and Canada. The ETFs have opened up the doors for many investors to gain exposure to the asset class through a brokerage account. Each ETF provider has provided their own research into the topic. BlackRock has written a report about how it can be quite a unique diversifier for clients' portfolios. The other ETF providers have done similar research reports. The great thing about those reports is that they clearly lay out the plethora of risks as well. It's an emerging technology and an incredibly volatile asset. There are also plenty of risks with the ETFs that have been raised by FIDRs, such as concentration risk, price distortion, custodian risk, and more. Speaking of risks, let's now go over the bearish narrative surrounding Bitcoin and the risks involved with investing in the cryptocurrency. The bearish narrative and risks. Every coin has two sides, even digital ones. There are risks to the bull case, with the most immediate being the chance that Congress blocks the proposal for a strategic reserve in the US. Senator Kristen Gillibrand, a Democratic but pro-crypto, questioned the purpose of such a reserve. Other lawmakers may be more skeptical. Since the proposal for a strategic reserve is already likely priced in, a rejection would possibly be negative, at least in the short term. There are plenty of other risks outside the regulatory side too. Firstly, as mentioned, there are concerns around market concentration and custodian risk at the ETFs. Secondly, it's still an emerging technology, so there are risks that the ecosystem may have unforeseen challenges as it grows. Thirdly, the path to broader adoption is very uncertain. And lastly, the currency debasement argument could reverse if governments decide to reduce expenditure and rein in expenses. Either way, volatility is likely to remain a feature of Bitcoin for some time, even if the most bullish scenario plays out. The fact that Bitcoin can't be valued like an income-generating asset means there is no value it can be anchored to. As mentioned in the quote at the start, most of the value comes from the value that others place in it. Much like other commodities and investments, demand will always be subject to bouts of speculation and the availability of capital. Some positions will always be held with leverage, meaning some holders will become forced sellers if a correction occurs. So, what's the insight? Broader interest is growing, but the commodity isn't without its risks. Bitcoin is receiving a lot of attention for its potential as a store of value. It's an emerging technology and nascent protocol that is still in the early days. What started out as an invention 15 years ago and was only discussed in small cypherpunk communities is now a globally recognized $2 trillion asset. However, while the possible price appreciation has made it an appealing prospect to some, prospective investors are all too aware of its history of volatility. It takes a certain temperament to be able to handle those kinds of drawdowns, and it's almost certain that it will have that kind of volatility going forward. If the bullish narrative plays out, then the commodity is well positioned to receive additional inflows as investors, both large and small, decide to allocate a portion of their capital to it. If the bearish narrative plays out, where governments rein in their expenses and become fiscally responsible, or there is a flaw in the protocol or disruption in the network that causes miners and holders to leave, then the price would decline because the value that others place in it has been lost. But as always, the best way to look at this, as with any investment, is from a probabilities point of view. The more conviction you have in the asset and the narrative behind it, the more you'd probably allocate to it. The less the conviction you had, you'd either stay at 0% allocation or allocate only a few percentage points. Vanek has outlined how some model portfolios have improved returns with only a small allocation to the asset class. Granted, they are an ETF provider, so they have an incentive to sell this product. If you believe an allocation might be right for you given your financial goals and risk profile, then there are a few ways you can get exposure to the asset class. Firstly, the spot ETFs that own the underlying Bitcoin. Secondly, any stocks that have exposure to Bitcoin, and we've created a screener of global stocks with exposure to Bitcoin, which you can find in the article. And lastly, the underlying commodity itself. Each option has its own benefits and drawbacks, which you need to thoroughly consider and evaluate against your personal financial goals, risk profile, and temperament. There's a chance that Bitcoin could go to zero, and there's a chance it could go to $10 million per coin and beyond. As the original creator Satoshi Nakamoto said, I'm sure that in 20 years, there will either be very large transaction volume or no volume at all. Well, we're 15 years in, and so far, things are moving towards the former. And that's all for this week's Market Insights. To see the key events during the next week, check out the tail end of the article, which will be linked in the description. Thank you so much for listening, and until next time, invest well. Simply Wall Street analyst Michael Paige has a position in Bitcoin and Microstrategy. Simply Wall Street has no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock and does not take into account any of your financial objectives or your financial situation.